Welcome back to Fulfillment Key, and today I'm going to talk about PFFA, which is a ticker that you guys should be interested in. If you're not, I'm going to put you on. But today we're going to talk about dividends from preferred stocks. Now, you may be wondering what a preferred stock is. Now, a preferred stock is better than a normal share. It's something I have to do more research on, but in the case that something were to happen with normal shares, if a company were to go bankrupt, you'd be entitled to nothing but the share value generally. However, with preferred stocks, you are generally subject to the portion of the assets if the company were to go bankrupt. Obviously, this is a scenario that's not very common, but it's still nice to know that you're going to get a portion of whatever you invested in. Obviously, not the share value before it crashed, but whatever percentage or whatever money you had in there would be proportionate to the number of assets that you get in the case that a company goes bankrupt. However, this is just an added benefit to preferred stocks. Now, what I want to talk about first for this fund is the fact that it has no return of capital or long-term gains whatsoever. If you take a look at the chart right here, you're going to see that the dividend income is legitimately income. There is no capital gains short-term. There's no return of long-term capital gains. The entire distribution is coming directly from the debts and corporate securities that are part of this fund. And if you'll notice, recently there was an increase in the dividend of 1 penny, which is not a lot. However, it's nice to know that the fund is increasing the distribution. And if you look at the distribution rate as of now, since the fund is a bit younger, was recently opened in 2018, the fund is not one of my biggest and most reliable and safest plays. However, they've shown very good performance, reliability, and sustainability with the securities that they've invested in, as well as their distribution history, as I've already mentioned. But if you take a look at the 30-day SEC yield, you'll see that it's 9.15%, which is extremely good considering what I'm going to tell you later. However, the yield as of March 31st, 2021 is 7.99, which is 8%. However, this is a monthly dividend. 8% is generally good, but this fund has a lot of upside. So if you look here, this is the part that I was most excited about when I was putting this together for this video. The Virtus InfraCap US Preferred Stock ETF. It is not a closed-end fund, which we generally cover. However, it has the returns of one due to its use of leverage. You can see that over the last year, 107% increase. This is by far one of the craziest returns I've seen for a dividend yielding stock, because if you had bought at the lowest price of $11, you would have secured a 15% safe dividend yield. That is what's great about these closed-end funds and preferred stock ETFs and other dividend securities that we talk about here, because they return insane amounts. And they also have a lot of upside. So let's talk about the management team for this ETF. Generally, people want to know who the management is behind an ETF, although most ETFs are known just for the ETF itself. But I figured I might as well tell you guys. So J.D. Hatfield started in the industry at 2000, and he started managing this fund in 2018. Edward Ryan, on the other hand, started much, much longer ago and has a good history since 1980, and he worked in this fund since the start of 2018. Sorry for the pause there, but these are two really solid guys in the industry, and if anything were to happen to them, knowing Virtus, they would put in another management, as that's a common fear that people have when investing in funds that are run by two people, but obviously they're going to be traded in with someone else if anything were to happen to them. So let's talk about what I'd mentioned earlier, which is the dividend yield if you had bought at April 2020. As you can see, 15.3% is an insane amount for what the stock was at. This was a little bit of the bounce back after the first COVID scenario had happened in the market. But you would have locked in that 15.3% dividend yield. Obviously, you don't want to put all of your eggs in one basket, but let's say you'd put in about 10 grand, 20 grand. You would have been yielding 15% on that money. To this day, you would still be yielding 15% on that original money. And you would have gotten a 107% increase a year from that date. So if we look at it, the combined yield on cost is 122.3%, which literally mirrors tech stocks for that crazy year that they had, besides Tesla. But it gives you that liquidity that dividends have, that you don't need to worry about pulling out your principal, which is a really awesome feeling, because you know that the distributions generally will not be cut, knowing that the funds are picking strategically the companies and bond securities that they hold, the corporate debt that they hold, and the securities, like I mentioned, that they hold. So you're probably asking now, how does this fund even yield 8 to 9%? And this is where we come back to the concept of closed-end funds, which utilize modest amounts of leverage to sometimes higher amounts of leverage. But ever since the 2008 crisis, they have not been allowed to use a certain number of leverage, at least for consumers. On the back end, they probably do, but we don't talk about that here. So this fund seeks current income and secondarily capital appreciation through a portfolio of preferred securities issued by U.S. companies with market capitalizations of over 100 million. So essentially what this means in normal people speak is that they first try to make the fund return income for its investors, and secondly, try to create or try to appreciate the assets of the fund, or try to invest in assets that will appreciate over time. But the first focus is for income for its investors, and the companies generally have market caps of over 100 million. And you're probably wondering, okay, I understand that. Now, how do they juice up those returns to 8 to 9%? Because normal dividend stocks are not able to do that. In this corner of the market, modest leverage, like I said earlier, typically 20 to 30%, is utilized to enhance the portfolio beta, and option strategies such as covered calls and covered puts, sometimes even straddles, are used in an effort to enhance current income, similar to the fund we may have talked about on this channel, which is QILD, or within the group, which is a covered call, covered put fund that sells option strategies solely to create income for its investors. Ignore that. And let's break down how, what I just said earlier, they use leverage and what they invest. This is a little chart that I put together. As you can see, corporate securities preferred stocks and debts that they hold from companies, option strategies, covered calls and puts, and modest leverage to increase the return from the general coupon rate. The coupon rate would be the percentage that they are owed, from the corporate debts that they are owed. So if you guys enjoy this video, please subscribe. As I say, always like the video, put any questions you have in the comments. We're trying to build the best community so all of us can retire early and have a basket of securities that can pay us to retire early. So, like I said, subscribe, be tuned for more stocks, more amazing videos, and that's it. Peace out.